So I wanted to know from you that what inspired you to actually create this bridge, when it comes to convincing government particularly and these large organizations to actually adopt blockchain. I mean, what sort of inspiration you had there, and how did you crack it actually? How did you convince them? Because I'm sure there is a very good story behind it.
Yeah, well, Franklin Templeton, we've been around for a long time and have a history and culture of compliance. So for us, when you're looking at the way different companies in the space have approached the regulators, it's been one of two ways, either collaborative or combative. And for us, the idea of being combative with our regulators wasn't something we ever entertained. We thought that we should be collaborative. So we began a dialogue. I mean, we started building, educational channels so we could talk to them about all things blockchain. We set up ways that they could contact us if they had any questions about things that were going on. We filed things, publicly. So we went about it in a completely regulatory compliant way. And it wasn't, that was the initial journey with the US regulators, but now we have products that are regulated across the globe. And our mantra and our style with the regulators is very consistent. It's this collaborative approach where we explain to them kind of what we're looking to do, why we're looking to do it, why we think these technologies are, imperative to build a sound financial infrastructure going forward, and how, quite frankly, some of them are a lot more performant than existing systems. So, having that as your base, your North Star, is really work at this in a collaborative way. It really helps us to find success.
For the near term, is money markets the only thing that is going to be tokenized, or is a big organization, institution like Franklin actually going to be looking at the hard assets as well, like real estate, and tokenizing it and kind of packaging it for their investors?
Of course. Now, I would say that the nice thing about a money market fund being tokenized is because the NAV is designed to hopefully stay at $1. It can move around all the time at $1, move around like traditional cash all the time. It's not bank account or something like that. You can start to draw some parallels there. So that's the nice thing about this asset. When you move assets off hours, you start to ask questions like, okay, if I could cut an NAV every single time I move an asset, how am I getting pricing on the underlying if it's off hours, and how does that all work? So it's becomes this huge operational lift to tokenize other things. But yeah, our vision for the future is that we think that the wallet is the account of the future, and people are going to have all of their assets in one wallet together, pay for certain things with your assets if you want, and stuff like that. So yeah, our vision for the future is that a lot of things get tokenized, not just money funds and not just financial products, really a lot of different things.
Hello everyone, welcome to yet another episode of Voice of Web3 powered by CoinGape News. It has been an eventful week, I would say, with a lot of geopolitical discussions, debates, negotiations going around. Of course, Iran, US, Israel, they are at the central stage today when it comes to geopolitical news, and crypto is also getting impacted with it. But we do have a silver lining, I guess. I mean, the institutional adoption for crypto, it is skyrocketing. We are seeing more and more of tokenized stocks coming into picture with live trading. We are seeing so much of tokenized gold coming into play. And now we are also seeing real world assets that are being launched by various blockchains. So institutional adoption is a story that needs to be understood very well. And we need somebody on the podcast who can help us what is going on behind the scenes when large institutions actually think about digital assets, they think about blockchain, they think about crypto. So today we have a very special guest who will help us understand what is going on in the world of crypto when it comes to institutional adoption. So today, guys, we have Mike Reed with us. Mike Reed, he's popularly known as for the on-chain US government money fund, FOBXX, that was launched by Franklin Templeton. You must have heard about Benji Tokens. He was one of the phenomenal people behind launching these Benji Tokens. And when it comes to digital assets and particularly traditional finance, you will often hear his name. You will often hear people talking about his leadership. So one achievement, as I told, FOBXX, if you have not checked it out, please check it out. This fund actually holds a distinction of being the first US registered mutual fund to use public blockchain for processing transactions and recording ownership. So, guys, today we have Mike Reed with us. He's Senior Vice President at Franklin Templeton. You can always check him out on LinkedIn and various other channels. He's right now heading digital asset partnerships development. So, guys, today he will help us understand that what exactly we are meaning by institutional adoption and what should retail as well as institutional investors take out from it. So, Mike, welcome to the podcast. Welcome to Voice of Web3. How are you?
I'm great. How are you?
I'm doing great, Mike. We were in Dubai, I guess, 3 weeks back. So, a lot happening in I mean, everywhere, not just crypto.
Yeah, it's kind of a wild time in world history. We're seeing it all come to bear right now. It's pretty crazy.
Mhm. So, Mike, I mean, we often hear you talking about blockchain adoption. We often hear you talking about the growth in the digital asset adoption when it comes to organizations as well as smart money, Wall Street adopting it. So, I first wanted to understand from you that when it comes to the digital asset adoption, how did it pique your interest? I mean, what brought you to digital assets and crypto in the first place?
Well, pretty innocently, we had a member of our team years ago who came onto our trade. So I used to work in fixed income business at Franklin Templeton. And I sat on a trading desk, very open environment. And somebody, Roger Baston, who founded the whole effort in digital assets. Roger came onto the desk one day and he said, my son was playing in a video game tournament and he won and he got paid in Bitcoin. Does anyone know what Bitcoin is? This was like 15 years ago. And so that really started our journey of learning about the space. So we were learning for a long time, trying to understand it better. Ethereum launches, you start to learn about smart contracts, programmable money, things like that. And for us, it felt like there was really something to do in the space. We're very fortunate. Our CEO, Jenny Johnson, used to run operations for the company. And so when we talked to her about ledger efficiency, it was something that she was passionate and excited about diving into. And so she gave us some budget. We hired some developers and we're kind of on our way after that.
So, Mike, another important thing when we were researching about your profile, about your background, was that we could see you have done so much of work when it comes to with regulators, with US government in particular. And when we talk about crypto, regulations are something we all are afraid of. We kind of try to shy away from it. We try to run away from it if we can. So I wanted to know from you that what inspired you to actually create this bridge, when it comes to convincing government particularly and these large organizations to actually adopt blockchain. I mean, what sort of inspiration you had there and how did you crack it actually? How did you convince them? Because I'm sure there is a very good story behind it.
Yeah. Well, Franklin Templeton, we've been around for a long time and have a history and culture of compliance. So for us, when you're looking at the way different companies in the space have approached the regulators, it's been one of two ways, either collaborative or combative. And for us, the idea of being combative with our regulators wasn't something we ever entertained. We thought that we should be collaborative. So we began a dialogue. I mean, we started building, educational channels so we could talk to them about all things blockchain. We set up, ways that they could contact us if they had any questions about things that were going on. We filed things, publicly. So we went about it in a completely regulatory compliant way. And it wasn't, that was the initial journey with the US regulators, but now we have products that are regulated across the globe. And our mantra and our style with the regulators is very consistent. It's this collaborative approach where we explain to them kind of what we're looking to do, why we're looking to do it, why we think these technologies are, imperative to build a sound financial infrastructure going forward, and how, quite frankly, some of them are a lot more performant than existing systems. So, having that as your base, your North Star, is really work at this in a collaborative way. It really helps us to find success, or helped us to find success in those early days. And, because of that success was something we kind of carried with us going forward.
Yeah, I mean, I started my journey, career in crypto. You can call me a crypto native investor if you will.
Great.
I know nothing about institutions, to be frank.
Okay.
We have been just wondering. I mean, so when we hear that, okay, Franklin Templeton is actually entering into the crypto space, they're going to tokenize. various they're going to bring these assets on chain. It's always a very, I would say, curiosity point for us. I mean, why Franklin Templeton wants to do this? I mean,
Well,
what do
hold on. I don't think it's just curiosity. I think it's skepticism. We're met a lot of times with skepticism by the community.
you
Or
can
have
call it? Yes,
at a
yes,
certain
I
point.
agree with you.
Totally understand, and you understand it. But I think the way that we've approached it over time has been very cognizant of that skepticism, and we've tried to build out different products and services, or I don't know, build out kind of a culture that is very crypto native. So, for example, we run validator nodes on 11 different blockchains. We run 30 nodes across those chains. Now, the reason we do that work is twofold. Number one, if you're running product on chains, we think that it's imperative, especially securities, like these are security, digital asset security, these are security tokens. If you're running these products natively on chain, and you have customer money in it, it's imperative that you have your own copy of the records. And so we run nodes so that we have our own copy of the records. But the second reason that we do it, which kind of goes undercovered, is this idea that if you're going to be involved in these new ecosystems, it's kind of imperative on you to be kind of, supportive and help to secure the network and, be an authentic part of these ecosystems. So if you look at our business approach throughout history in this space, it's been very crypto-centric and very crypto-native. I mean, our product, for example, is minted natively on chain, where there are no off-chain book of records. Most money fund constructs out there that are tokenized money funds, there's an off-chain book of records, an off-chain transfer agent, and then you have this kind of on-chain receipt token, more or less. And when you move that asset around 24/7, it doesn't authentically reconcile until the book of records of the product open, which means that if I send it to you at 2 a.m, it's cool and all, but you don't really own it until the next day, until the next business day. Our product doesn't have an off-chain book of records. So if I send it to you at 2 a.m, you know that it's yours because it's living in your wallet authentically. So these, I'm sorry, I didn't mean to interrupt you in the middle of what you were saying, but the idea that we go to these places.
My question was, please continue.
Yeah. So we go to these places and we talk to people, and I think as soon as they start to hear our chops and like our tech chops here, and then also why we're doing it this way, it's all very crypto native and authentic to the space, and really honoring the legacy of the space, and trying to meet crypto natives where they are. But maybe I'm jumping ahead here. We have a construct, for example, where users can buy one of our assets, post it into a wallet that's off an exchange, and then the collateral is mirrored on the exchange. We have these arrangements with Binance, OKX, like this is public information. Onboarding people into a construct like that, there's two camps. There's the crypto natives, and then there's the traditional investors. Now, the crypto natives are like, what do you mean I need a bank account? KYC controls, like, how does that work? That's like that camp. So we explain to them what we're doing. We're heavily regulated, but our construct is better in most cases than what you're using now. And so they come across the line with us and they're like, okay, I get it, all on board. And then we're off to the races. The traditional investors are excited that a player like us is in the space. So they're like, finally, I can get involved with someone I know. And then we start to talk about crypto trading conventions, and they're like, wait, this is different than anything I know. And so you bring those investors over the line as well. So we sit kind of at the intersection of both camps and understand the needs of both camps, and can help to bring both of those investors, into the to be able to build something that for everyone.
I mean, so the way you are describing it is, of course, where you're trying to create a bridge whereby the existing crypto native users who have had that experience for almost now 8 years, 9 years, are not finding it very difficult to actually kind of, use your products. And on the other side, you're creating an environment where the same investors, I mean, traditional finance investors who have that compliance friendly environment they have worked in always, they also feel that secure environment there. And it raises the natural question. I mean, it's a very big news for any crypto asset or any blockchain infrastructure company whenever it is announced that Franklin is working with them, I'm sure. But it raises a question that what sort of steps or what sort of benchmarks you have at your end whenever you are evaluating these companies, I'm sure a lot of companies are reaching out to you on a daily basis. So how does Mike or how does Franklin actually select these partners to these crypto and blockchain companies?
Well, I would say on the blockchain side, we have a very robust tech suitability framework that's public. It's in our prospectus. And if anyone is watching this and is interested in partnering with us, we're happy to share that right away. And so that kind of sets table stakes that we need to be able to engage if we're going to develop on a new blockchain. We also, and this applies to like every business that we get engaged with, we have a business development suitability framework. And what we're trying to understand there is how is engaging in this project going to help to grow our asset, not just for AUM for us, but so that it proliferates throughout an ecosystem. So we get approached, you're right, we get approached a lot by folks. Sometimes they say, if you engage in our product, we'll invest X. And I mean, that's very nice, but you know, what we're really looking for is the line of sight to how we can grow big together. So, you know, again, like sometimes we invest in people, sometimes they invest in us, sometimes we do tech builds together, the partnership stuff, but it really all comes from this like suitability framework. And is it going to make sense for us? I would say that's kind of one thing that we really focus on. Another thing that we really focus on is, you know, they have to pass through our legal and compliance due diligence. And we engage with all of our business partners, whether they be traditional or crypto native or whatever, across our whole business. So we have, you know, we engage with folks in that space and have teams that do deep due diligence on different groups that we work with. And maybe the last thing is that we look for is really a spirit of true partnership. If a lot of the times you can talk to people and you find out they just think because we're a big company, we have deep pockets and that we're willing to throw money at any kind of opportunity. And that's certainly not our ethos. I mean, we're almost run like a startup within the overall organization. So we have to be conscious about how we're deploying assets and deploying, you know, ideas. I think we're really good. Like one of our secret sauce kind of ingredients is that we're really good at cutting bait on bad ideas fast. But we don't want to have any bad ideas enter our pipeline. You know, we want only good ideas. So when we meet with people, if someone's like, I've got this idea, you know, invest with me a bunch of money and then, you know, we'll figure it out from there or something like that. That's not a partnership. That's somebody who's just looking for a Franklin Templeton check or to get us on their cap table or something like that. What we're looking for is people who really want to say, okay, this is how it benefits all of us. And also, again, the North Star for all of this is, does the end client get any kind of benefit from this? And we want to make sure that the end client is receiving something good out of it. Maybe to give you an example of kind of this thing and how it can go both ways. When we first tokenized our asset and we were talking with traditional players in the market, they were like, this is cool but our existing money funds work in the ecosystems we play in. They plug into all of our systems. You know, in some ways, this is not good for us because now we have to get a wallet. We don't even know what that is. You know, so they were like a little hesitant about engaging. But as soon as we started talking about some of the feature sets that we have added to the product that make it better than the existing solutions they use, that's when you get real traction. So for example, one of the features that we have is something we call intraday yield. And the thesis is this: if the asset lives authentically on chain, shouldn't you be able to cut the rewards associated with it up, you know, on a blockchain clock instead of a traditional clock? So, you know, money fund convention, the way that it works is that if you own the asset, when the market closes, you get the yield for the day. And then that yield accrues over the course of however long the time period. Most money funds pay monthly or quarterly. Instead, in our construct, we pay 365 days a year. So we pay on weekends, we pay on holidays, we pay all the time. And you accrue yield on the product by the second, which means that if I send you that asset at 2 a.m. on a Sunday, not only is it authentically yours because it's authentically on blockchain, like we talked about earlier, but you begin accruing yield for the day at 2 a.m. on a Sunday. And at the end of the day, when the income payment occurs, I would get 2 hours of income. You would get 22 hours of income. Now, all of a sudden, for you know, the bulk of crypto trading is done not in U.S. market, not on U.S. market hours. So this becomes an ideal asset for those types of constructs because it lives all the time. Think about larger things. I mean, collateral, obviously, but then like trade finance, right? There are situations around the world where someone holds collateral for 4 hours a day, every day, and then ushers it to the next place. It might be $10 million worth of collateral. Well, $10 million worth of collateral for 4 hours, it's a good amount of yield. But then you compound that with every single day you're doing that same trade. All of a sudden, you're earning 4 hours of yield on that $10 million every single day. It starts to add up. And so the end user is able to fully recognize the economics of their holding, which is something that can't necessarily be done with the current systems. I mean, current systems cannot calculate yield accrual by the second. They're just not robust enough. But because blockchain is so powerful, it allows us to build feature sets like that into our asset, which creates this kind of great end benefit to the clients. That was a super long answer to a question.
No, it's fine. I mean, see, I would be very frank with you that most of our audience, I mean, whatever you are saying is information for us, to be frank. I mean, we are lucky. I even asked, our audience that Mike from Franklin Templeton is coming to the podcast. You know what? The most suggested thing was that make sure he speaks more. I'm like, okay.
Okay, sure. Yeah.
Okay, I'm gonna maintain it.
Okay, I'm here for it. Yeah. Whatever you want to know. We're pretty. So here's another like blockchain ethos kind of thing. We're pretty open to talking about what we're working on because we're still early, and I know it feels like we're not because there's now regulation in place. Institutions are in the market. Everyone's being very, very public about it, but we're still so early on this journey that by talking to people about what we're thinking, it hopefully helps to elevate everyone.
So yeah, I mean, so crypto, obviously, if you see cycles for the last 7-8 years, it has worked on these various narratives. So in the early beginning, it was all about decentralization, DeFi. Then we saw the boom of ICOs in the form of companies, project that can raise so much of money with just a white paper. And then after that, regulation came in. Then we see the rise of Binance and these exchanges. And now the narrative seems to be, of course, AI and the RWA. And even when we talk about RWA, we are seeing that money markets, they're getting tokenized bonds, treasuries, even the stocks. We are seeing they are tokenized. They are getting tokenized at a very rapid pace as compared to hard assets like real estate, as compared to hard assets, maybe like, wine collections and collectibles. So we are not seeing the same trajectory of growth when it comes to hard assets. And this is what my next question is that for the near term, is money markets the only thing that is going to be tokenized, or is a big organization institution like Franklin actually going to be looking at the hard assets as well, like the real estate, and tokenizing it and kind of packaging it for their investors?
Of course. Now, I would say that the nice thing about a money market fund being tokenized is because the NAV is designed to hopefully stay at $1. It can move around all the time at $1. Move around like traditional cash all the time. It's not bank account or something like that, but you can start to draw some parallels there. So that's the nice thing about this asset. And when you move assets off hours, you start to ask questions like, okay, if I could cut an NAV every single time I move an asset, how am I getting pricing on the underlying if it's off hours, and how does that all work? So it's becomes this huge operational lift to tokenize other things. But yeah, our vision for the future is that we think that the wallet is the account of the future, and people are eventually, as accounts kind of go away, people are going to have all of their assets in one wallet together, pay for certain things with your assets if you want, and stuff like that. So yeah, our vision for the future is that a lot of things get tokenized, not just money funds and not just financial products, really a lot of different things.
Yeah, I mean, so when it comes to, again, I mean, we are talking a lot about adoption in the form of institutions adopting crypto assets, blockchain rails, various companies coming into picture. We all are eager to understand that what kind of regulatory milestones you're looking at, because personally, I believe as a retail investor in crypto that you guys are far more experienced at looking what value these regulatory developments are actually going to make as compared to us. So are there any particular regulatory milestones you're looking at in next, let's say 5 or 10 years, that you believe will actually be the pinnacle, will actually kind of, further grow this industry, or I would say institutional adoption of crypto?
Yeah, well, I mean, I think that a lot of people look at kind of big regulation as being the solution. So, like, clarity, or when you get passing of new legislation, finally we have legislation. And I would say that, like, the thing, even traditional financial markets, the thing that they like more than anything else is to kind of be able to see the future and know what's coming and have no big surprises. And regulatory clarity at least helps to kind of frame that. And I would say also one more thing is that it is an apolitical statement to say that the current administration is more favorable towards crypto regulation than the previous. So I think that's the reason there's a lot of people excited about what's happening in the space. But I think it's way more nuanced than people appreciate. So, for example, there was the SEC Special Accounting Bulletin 121, which was a real problem for people who wanted to custody assets, because when you custody the assets, you had to hold $1-for-$1 on your balance sheet for any crypto asset that was custodied. Essentially, that puts a freeze ray on anybody who wants to build a business there, because it becomes deeply capital intensive. The lifting of that allows for traditional players, and there's some great crypto custodians who are in the market who all they do is crypto custody. We partner with a lot of them. They're really, really great. There are some really, really great solutions out there. But the lifting of SAB 121 really allows for custody to move into the institutions. And I don't know if that happens through building, which some are doing, acquisition, which some are doing, or how that look, the framework of how do these institutions who have performed traditional custody include crypto custody as part of the solution. But I think that's a thing that went like super undercovered in terms of regulation, because once you have custodians that you trust and you like, then all of a sudden the institutions feel like their assets are safeguarded and they can engage in a more deeper and more meaningful way. One of the things that we have with our custodian partners for our ETFs, for example, the wallets that the assets sit in are insured. And so, insured up to a certain amount, and then we break the assets up of the ETF so that we won't go over that limit of insurance. That situations like that, when we're engaging in due diligence conversations around our products, really helps to give our clients who are in the traditional space a lot more comfort around the fact that their assets are getting safeguarded. Again, so I'm not avoiding your question at all. There's huge things that are coming down the pipe in terms of regulation. But I think oftentimes it's the smaller things that people aren't really thinking about that are going to open massive floodgates for people who are, in the institutional space to be able to engage.
Yeah, I mean, so there is, of course, a lot of excitement around Clarity Act. We are seeing DeFi finally getting a chance to be debated. We are seeing a lot of discussions around DeFi.
Yeah.
And DeFi, I mean, of course, the yield that people are getting by holding their assets on chain, for example, maybe stablecoins even, are quite superior to what they might have got when it comes to traditional finance. But yes, it raises the risk bar. I mean, so this is where my next question is about, or where I want to put our next question is that I'm sure that you are throughout the year or month, you are always evaluating one blockchain with another. I'm sure that when it comes to where your investors' assets are being held, I mean, it's a very big choice for you. I understand it's a very big decision for you. So when you personally are, let's say, looking at public blockchains today, so of course, there are right now around, I guess, 100 plus easily, we can say. There are 100 plus public blockchains at the moment. What sort of framework or what sort of, let's say, decision making you are doing at your end, where you say that, okay, this public blockchains, we feel that our investors' assets will be safe as compared to this other blockchain. So are there any particular blockchains that you feel today are more safer, secure as compared to this lot of chaos in the market?
Yeah, I mean, we would never have our asset live on a blockchain that we didn't feel good about. And so, like I said, we're on 9 public chains right now. And, our initial launch partner was Stellar. We went on Stellar for a bunch of reasons. One of the reasons, quite frankly, was because in the beginning, they didn't have smart contract capability. And that kept the conversation with the regulators pretty
Oh, wow.
good. Yeah, you know, this is a thing where regulators start to ask questions like, they're like, wait a minute, if it's a smart contract and it's all programmed into code, can there be some kind of automatic unwind of my asset? What happens if this? What happens if that? So eliminating that from the conversation in the early days, you know, kind of helped. But I would say since then, Stellar's evolved, and you know, we're on many blockchains that do a smart contract capability. So Stellar, Polygon, Aptos, Avalanche. Stellar, Polygon, Aptos, Avalanche, Arbitrum, ETH, Base, Solana. We just most recently went on Canton. Oh, there's someone I'm forgetting. I shouldn't have even started down this path without having them all written down.
Oh, it's fine. It's fine. It's fine. We will on the screen. There will be a list of all the blockchains. It's fine.
Okay, cut this out then. Cut me out listing them, please, because I'm trying to remember.
Okay, it's okay.
Stellar, Polygon, Arbitrum, Stellar, Polygon, Aptos, Avalanche, Arbitrum, Base, ETH mainnet, BNB Chain, Solana are the public blockchains that we engage in. And you can see where the assets lie. Actually, our two blockchains that have the most amount of assets right now are BNB Chain and Stellar. So, and then Canton we also have on. So yeah, if you could just cut all that out, I would really appreciate it.
Sure.
Okay, cool. So I would say that when we look at a blockchain, the first thing it has to do is pass that really, really robust tech suitability framework. And once we pass through the tech suitability framework, you know, then we can engage in a more meaningful conversation. But you're right; it's all about having the investor assets safeguarded. Another thing that we look for is a use case. So, for example, with our construct that we built with Binance, being on the BNB chain just made sense to be able to be in that ecosystem. So the use case was apparent and obvious. Now there's others like, you know, Arbitrum, for example, where Arbitrum, there's a lot of DeFi done on Arbitrum. Our assets are permissioned. So for us to engage in permissionless environments takes a lot of legwork. But we thought in the future, we want to be able to engage in these ecosystems if we can. And it felt like Arbitrum was a good place to be. So you have to have these kind of use cases for why you would be on any of the blockchains, or else there's, you know, quite frankly, no reason to go there. And that's something that we look for sure.
I mean, this is interesting, and this is what comes as learning to all of us. When you rightly said that the choice of Stellar was not about how wide their scope of work is today. It was more about how they are regulation ready. So I mean, this is how, what difference is there when an institution is thinking, and when let's say a small SME or a small maybe company is thinking that how to adopt these blockchains. And I'm sure that as a big organization, you always first have to get that checklist checked first, whereby at least everything is on par with the regulators wherever these companies are working in. But again, I mean, so I have seen a lot of details. So Franklin is definitely one of the best organizations when it comes to putting out everything transparently, why and how you're doing it. So one of the reasons for this podcast is, of course, to kind of inspire and motivate retail investors to finally start doing their own diligence, to go to your pages, to finally start understanding how an institution is thinking about crypto. And this is where my next question is coming, because we are seeing, so as and when, let's say there is an update, okay, Franklin is maybe for a particular use case collaborating with Stellar, you will see so much of misinformation around it day one.
Yeah.
As it will skyrocket, there will be so much of media coverage around it. And then suddenly, slowly, everything will come out that, okay, this was maybe more about an infrastructure play, and this was not any investment or something like that in that particular blockchain. So this is where my next question is, that when you select these blockchains, is it because there is an investor demand, or is it because of an infrastructure play? I mean, what is motivating Franklin to get into public chains or to collaborate with them? I mean, why not private blockchains? Why not create your own blockchain, for example?
Well, I mean, the solutions are out there are great. We've got an amazing technology team, but designing our own public blockchain, you know, what we would never want to design is something that was basically another database. You know, so for us, like going on public blockchains made all the sense in the world. I would say that when we started, you know, so I mentioned the construct we have where users are using our assets as collateral. When the traditional investors came on, one of the things they said was like, wait a minute, so all my information is going to be living in this public place? And we said, first of all, no PII, so no personal identifiable information is going to live on the public chain. But second of all, what would make sense for you? And the traditional institutions were saying to us things like, we don't want people to see our trades, as we're putting them on. We want the market to be able to live, and we don't want anyone kind of knowing what we're doing. So privacy is a thing for traditional institutions, which is why we devved on, Canton. So again, every single one of those blockchains that I mentioned, there's 10 of them. They were all for very, very specific reasons that we devved on all those chains. Some of them have played out great. Some have not, played out well. But they were all very, very a specific thesis as we went on those chains. And I would say like the things I talked about, the tech suitability framework, the BD suitability framework, the spirit of true partnership, the culture of compliance, like all those things had to live in those relationships as we were building together, or else we wouldn't have been able to do them, from the start.
Yeah. So, Mike, there are two more questions which we want to kind of, get your mind on it, get your points on it and your feedback. One of them is, of course, the scope of digital lending today. So we see a lot of DeFi growth being dependent on how finally investors will have an appetite to actually kind of finally leverage their assets on chain, finally use them as collateral, finally borrow and lend against these assets. And I know here and there is always some hack or some kind of a news that is kind of bringing the whole development down a notch. So I mean, what sort of demand or what sort of curiosity are you seeing at the side of investors when it comes to DeFi? Are institutions or are these large investors actually ready for DeFi, or do you see there is still some sort of, let's say, time we have? There is a timeline. I mean, we have before we actually see a lot of money coming into DeFi.
Boy, that's a great question. I would say, now you said like it kind of brings development down a notch. I might argue that it brings it up, because if people see where the problems and issues are, and then they can build solutions. Like you said, like it's important for people to understand these things so they can build around them, or build with those in mind at least. And so I think it actually brings if there's an issue that comes about, everyone's aware of it. They can start to build solutions that won't have those same issues. So just generally, now with regards to DeFi specifically, we have a permissioned asset that wants to be in permissionless ecosystems. And a thing for us that's never going to go away is we have to know our customer at every point in the journey. So if I buy our asset and I transfer it to someone else, that someone else has to be KYC by Franklin Templeton. It's a security. So we have to know who's dealing in our asset, who's dealing with our assets. There are groups out there who've tokenized our, ETFs, for example. There's groups doing that. Ondo is, got a pretty massive market cap in tokenized stock and ETF space. So there are assets out there that can live in permissionless ecosystems. But, when we're trying to talk about and think about how we're going to gain access to that space, DeFi is a super interesting thing. A lot of people, engage in it in their personal accounts, quite frankly, who work for our firm. So it's something we're deeply knowledgeable about, but trying to think of that interplay between securities, KYC controls, and DeFi is something that we're thinking about and evaluating constantly, quite frankly.
So, I mean, so the question was more about, because again, as I told you, the crypto space is all about narratives. The more the hype, the more the narrative, the more the retail pushes, the boost is there. And right now, it is a very big question for everybody, that where does DeFi stand today when it comes through the lenses of these institutions or through the lenses of the large investors? So do you see the technology is ready, or do you see there is still, let's say, a waiting time period of, let's say, 2 to 3 years before we actually start seeing large investors being interested or being so risk agnostic that they really want to put their money behind these DeFi protocols?
So I think, no, I understand exactly what you're asking. And again, like if I'm not answering your questions, please hit me on those and be like, hey man, give me the answers, because I'm never trying to give you a fake answer to avoid your question. So I want to make sure I'm getting to what you're looking at. So I would say this. So I think in crypto, something we fall victim to a lot of the time is we've got flashy terms for things that have existed for forever. Yield looping, for example, that's leverage. That everybody in finance understands leverage, and when you start talking about what yield looping is to people, they're like, "Oh, you mean leverage? That's what leverage is." So,
Yeah.
I think the concepts are things that people know. I mean, in traditional finance, there's dark pools. Like people understand these things. I think you have to separate out the risks, and there's an operational risk component where people want to understand and know that these ecosystems work properly all the time. And once they can gain comfort that the operational risk hasn't gone up, or at least you're compensated for that in some other way, whether it's return or whatever, I think that's when people start to engage in these things in a more meaningful way. Maybe to take the conversation out of DeFi for a second. So in the beginning of our product, of our journey in this space, we actually were running off-chain records at the same time as running on-chain records. And the systems, they were performant. We did that experiment for about a year maybe. And over the course of that year, there were something like 50,000 transactions in the product. It was like incubated friends and family mode. And across those 50,000 transactions, there were only a couple of errors. They were all on the traditional system side, where things like, there was a reconciliation error because the blockchain ecosystem or the blockchain transfer agent went out too many decimal points for the traditional system to reconcile with. So what you're showing there is that the new system is actually more performant, right? It's too precise is the problem with it, which is such a happy problem to have. So when you start uncovering things like that, then all of a sudden you realize, okay, I can pull off of the off-chain book of records, just go full blockchain. And that was kind of what we did, right? So now we don't have the off-chain book of records anymore, and haven't for years and years, and just go completely on-chain. The operational risks were actually in some ways diminished by running the system on blockchain. So now taking it back into DeFi, when people can understand that the operational risks are not worth it, but like they're being dealt with. They're being, like we talked about this idea of like elevating people's development in the space. Like when all of those operational risk concerns can be resolved, I think that's when you'll see a much more meaningful dive into this space. But I'll tell you candidly, because we speak with like banks, we speak with other asset managers, we network with everyone. Everybody's looking at this space right now, and there are some constructs that are able to participate.
So the
Did I answer your question? Hold on. Did I answer your question that time?
Yeah, you did. I mean, I understand that when you speak, you understand you have to speak with a certain clarity, and with, of course, a certain doubt as well, because we all know that DeFi regulations will be far more complex as compared to the crypto as an asset kind of a regulation.
For sure.
Understand that. I mean, because
but like the first time I get a crypto account, I'm all excited. I'm like, oh, this is going to be fun. And then the first time I transferred an asset from one wallet to another, it was gone, right? And so then I'm like, wait, why hasn't it showed up in the new wallet? And I was freaking out. And then all of a sudden it shows up, and you're like, okay, the new block of data had to be written for that asset to appear. And you start to learn things, as you engage in these spaces. So just saying like, I'm not going to do anything in DeFi and I'll just like let it happen, and when it's clean, then I'll get engaged. I don't think that's quite the right way to approach these things. I think you need to be steeped in it and deeply engaged. So that way, when your time comes, you're ready to go. I think of the ETFs, right? The ETFs, when an ETF launches, it's great, but you have this massive operational stack behind it. And because we were in the space for so long before the ETFs launched, building our operational stack, we knew all the players already. We built a really high quality stack underneath what we're doing. So you have to be always engaged in these things all the time.
Yeah, I mean, for me, the Eureka moment was when around 8 years back, I was to transfer somebody's salary in Africa, sitting in Dubai. And I was just talking with, banks that, okay, I need to send this guy $25,000. How much time will it take? How much do I need to open a new account in Africa to do that, or a new company, new entity? And somebody told me you can do it using a stable coin. I'm like, okay, let me try it out. And I did it within 1 or 2 minutes, I guess. And the guy received the money at his hand. I was like, okay. I'm getting why there is so much of hype around this. And
Yeah.
then for the first time, when I kind of put my some Bitcoin into DeFi protocol, and I borrowed around, I guess, 40% of the value I borrowed in USDT, and I utilized it for trading on Binance. I was like, okay, is it really this simple? So this is a user experience which I believe is really amazing. Number one, I mean user experience. And if somebody has used crypto, they are not going back to trade traditional finance. I can tell you that they are not going there. So yeah, I understand your point when you say that there has to be balance, because what I'm talking about is millions. What you're talking about is billions. So I'm sure that when a transaction is all about in millions, you can maybe be a bit flexible when it comes to security and when it comes to the safety of the assets. But when it comes to these large investors who have billions worth of assets, I'm sure you need to put that extra layer of security. And that's where I told that I understand your answer with DeFi, that there has to be that certain level of security and safety before there is big money that is piling to get this leverage and play around with these protocols. Now, the most debatable player in the space is custodian when you talk about blockchain and Bitcoin and everything, because the whole premise is self custody. And custodians for a long time has played a very key role. I can understand that. I mean, they are the ones who have actually made sure that there is a there is a symphony between, let's say, the investor as well as the third parties who are actually trying to utilize those assets. Now, how do you see this self custody? Do you really seeing tomorrow self custody being as one very big product in this space when it comes to, again, institutions, or do you see that there will always be a kind of a layer of custody at least?
Yeah. So I keep thinking about your example where you're sending money, and like just how much more efficient the systems are. And the reason they're so much more efficient is because on every step of the way, there's toll takers who are trying to get in between you and your kind of what you actually want to do in the space and
Yeah.
taking a small piece of it. My 15-year-old Kyle, he came to me and he said, I want to invest in crypto, me and my wife. And my wife said to him, Kyle, you don't understand crypto at all. And he's like, no, Mom, you don't understand. We need permissionless transactions. We need transactions without intermediaries. We need, he's like, so he watched some YouTube videos, picked up the gospel right away and sees
Mhm.
it. So I think I agree with you. Anybody who's engaged in this space, you see it and you're like, oh wow, this is a real thing. And a lot of it is because the people who are taking their slices along the way can be disintermediated. And again, end benefit to the client is they get better returns, better efficiency. There's like all these kind of better things about it. Custody is a real interesting thing, like I talked about earlier with the SAB 121 and all that kind of stuff. I'll give you 3 investor types.
Okay.
And how they think about custody. So the first would be Kyle, 15 years old. He doesn't even know what custody means, right? So he's just like, he's just all in, like, yeah, this is great. Maybe I'll give you 4 investor types. I have a friend who's about 30 years old, 100% of his life savings in crypto. I said to him when I first started in the space, I was like, and first of all, like, we believe in diversification, everything like that. But I'm like, what happens to you if it just goes to zero or you lose it or something? And he's like, well, then I just start over, because he doesn't have, kids. He doesn't have a mortgage payment and everything like that. So like, that's a second investor type. A third investor type is me, where, I have a house. I have 3 kids who have educational savings plans. So my stability of cash flow needs in life are significant. I have to make my mortgage payment on time. I have to make my property tax payment on time. I have to fund my kids' college accounts. So for us, our crypto allocation as a family is somewhere between 5 and 10%, depending on where we are in the market cycle, which again, amongst the crypto natives would be like, they think that was weak. I would say, okay, but this is the phase of life I'm in right now. And I need broader diversification across traditional products to be able to ensure that my family is able to do everything that we want to do in the near term. I can't, the volatility of the assets can be so severe that at times, if I need cash flow, I don't want to be selling stuff at a 90% decline when I feel like it's going to come back. But just the time of my life says I need money now. You know what I mean? So like, I get it. And then you have people like my dad who like wanted to buy crypto, but didn't want to have a self-custody solution. He was terrified of it. And so as soon as the ETFs launched, he felt comfortable engaging in the space. Now, all those players think about custody. Not only do they have like different life return profiles and everything like that, but they think about custody in different ways. It's so nuanced, right? Like, again, Kyle doesn't even know what the word custody means. The 30-year-old is totally fine with self-custody because if it all goes away, he doesn't care. Me, I'm this hybrid where I'm like, I think so I do have assets, self-custody assets. I also have assets that are custodied on a platform, and then I have traditional assets as well. And then my dad, who's like, I can't deal with self-custody because what if I lose my thumb drive and I have to buy a dump to be able to sift through garbage to find it and what. So I think it depends on what client type you're going after as to what type of custody solution you need. And I think that's the way custody will evolve. I think we're going to see this constant evolution. I think you're going to have a need for traditional not traditional, but like self-custody solutions like you talked about. And I think you're going to have a need for more traditional custody solutions as well. People who are in traditional custody haven't custodied crypto before. The idea of a hot wallet and a cold wallet is something that kind of, that's a jump you have to make to understand how those are different things and how it goes. So like I said before, we're seeing this real interesting thing where a lot of these traditional custodians are engaging in this space and learning about how custody works and why it's different and why it's a needed service for certain market segments. And they're building those solutions or acquiring those solutions today.
Yeah, I mean, so the next question is, of course, about innovations. I'm sure that you have kind of selected out a lot of problems that you're trying to solve today, maybe using blockchain, maybe using DeFi, or maybe utilizing the current crypto assets when compared to gold or some other physical asset. So the next question is, as you rightly said about privacy, even our last podcast with somebody from Night Token. So Night is a recent protocol from Cardano, which was launched around privacy, and we discussed with them. And there I understood that why privacy matters so much for institutions particularly. They don't want you to reveal their assets, net worth, or even anything online. They can't take that risk. So I understand privacy is definitely an innovation you're looking at. Are there any similar innovations you're looking at when you're looking at today these 50 or 100 blockchains which are in front of you? Do you see some other innovations as well, even maybe AI, for example?
Okay, two questions there, right? In blockchain innovation and AI, because I think there are really interesting things. Solana's got the extension, the Token 22 extensions that are real cool. For us, the innovations are really great and interesting, but because we have assets on so many different chains, any type of feature set that we use has to be able to exist in all the different blockchain environments. So those extensions are really cool, but not every chain can support them, right? So we can't necessarily utilize them in what we're building. It's just something to know. AI is really interesting, and I think the intersection of the AI and the crypto or blockchain narrative is so deep, and people don't understand it, right? Because AI had its its consumer-facing moment with ChatGPT. Blockchain doesn't really have that because aside from the fact that crypto trading is fun and it can be a great investment and all these kinds of things, blockchain is operational guts, which most people don't even think about. So the chance of that having this like big consumer facing moment where all the consumers start to care about ledger efficiency, probably not a big chance of that happening. But where they will care is that the compute that's needed for AI needs blockchain to exist when people think about that. And the AI agents that people are building and using to be able to trade on chain, all of that, those two narratives are so intertwined. To us, if you believe in AI, you have to believe in blockchain. They're so deeply connected. So that's kind of the way that we tend to think about it. You have to think about, if you're thinking about blockchain innovation, you have to think about it across a whole bunch of different chains. And then if you're thinking about AI, you have to be thinking about blockchain as part of that. I think some of the investment stuff that we've seen over the last, I call it 6 months, some of the investment movements that we've seen have been that there was money that would normally be chasing crypto that was chasing AI. And over time, as people start to understand how those narratives are connected, I think you see much more level setting going on there for sure.
Yeah. I mean, so recently, I mean, a developer in our team, what he did was that I'm sharing this you because for us even this is kind of a very pivotal moment. We see that the moment we see these AI use cases running on blockchains. So blockchains, we see blockchains, of course, running a lot of things in the future, and we do see these AI
Yeah.
agents running on blockchain in the coming days, whereby you can program, you can automate these kind of conditions, you can automate your controls, you can even automate compliance, for example, whereby if something is not meeting a regulatory compliance, you can just kind of take it off and it will not happen anytime. So we do see that blockchain forming this backbone of automated AI agents, whereby the sovereignty, even the compliance, and even I think the transactions, they are quite automated. And even I guess Coinbase CEO is quite bullish about it. He's saying that he sees world running on AI agents and we see the world running on blockchains at the back of it. So I was sharing with you an example that what this particular developer did was he just simply made an AI agent that allows you basically to kind of run your DeFi in an automation mode. So for example, the AI agent will kind of check out yields on various stable coins on various protocols, and then it will automatically choose the one that is, let's say, best for you, and then invest your stable coins on behalf of you. So that's kind of passive money, passive yield happening in real time, where you are not being asked to do anything. Plus, it follows the conditions that you're putting. So if you're saying that please don't invest more than $500 at any given moment, it will not. So I mean, yeah, we are also quite excited about it. And the last, so I understand I'm taking a lot of your time, Mike. I'm
Oh, it's
really thankful
fine.
for it. Uh, the last question, particularly, I again have is about the challenge that crypto native companies or businesses are facing. The challenge because the language that we speak and the language that you speak, to be frank, are very different right now. As you rightly said, we may be calling it DeFi, but you were already calling it something 10 years back. There is nothing new to it. But the language we are seeing right now is totally different. So I was recently kind of onboarding a client from US. He has a family office, and we were trying to kind of help him understand that how real estate can be tokenized. The debate, of course, got into regulatory segment first, where we feel as a crypto native company that it's very difficult for us because even we don't know what is going on there. We are very confident about technology, about adoption, even about use cases. But when it comes to regulations and when it comes to particularly following these compliance or making them inbuilt in the solutions, this is where I see Franklin or you playing a very key role in the coming days. So my next question for you is that if there is a business in crypto out there and they are working, creating something on blockchain, they are creating, let's say, a new asset on using blockchain or even crypto, what is your message to them? What are some of the factors you think that they should keep in mind that will allow them to actually create something that is worthy for institutions or large organizations?
I mean, all the stuff that we talked about, like compliance and all that kind of stuff, I think notwithstanding, the one thing I think that people don't think about is there a large, massive use case for what I'm building?
Okay.
I think about stablecoins, for example. There's a
Mhm.
ton of stablecoin providers out there, and there's some who've been very thoughtful as they've been building out, getting their asset integrated on. So, like for example, one of the reasons Tether is the largest stablecoin on the planet is because it's the asset that's most used in pair trading on exchanges.
Yeah,
Uh,
I
one of the reasons that USDC is the second largest stablecoin is because it's the second most used asset in pair trading on exchanges. So if
Mhm.
I'm building a stablecoin, depending on what the use case is for it and everything like that, I might think about trying to get it engaged in some of those constructs, right?
Mhm.
But I think instead what people see is they see, holy Moses, Tether is so profitable. They're making so much money. I'm going to build a stablecoin so I can make so much money
Mhm.
without having the real business case for or differentiator for why. And look, there's other stablecoins out there that do have that differentiator or do have that strong business development acumen. I'm thinking specifically about like RLUSD or the global dollar, Paxos global dollar, like things like that, where people are building out stablecoins that have real specific use cases.
Mhm.
And we manage reserves for multiple stablecoins, and we try and meet with these founders and talk to them specifically about like, here's why, here are things that you should think about as you're building your business. Because quite frankly, if we're a reserve manager for a stablecoin and they grow, we grow with them. So we want to
Okay.
be able to provide that like consultative function so that they can grow. but you have to think of a real use case. And I would think if you're building any type of project and you're trying to appeal to institutions, remember that the market cap of crypto is a few trillion, right? The market cap of the rest of the investment world is over 100 trillion. So if you're trying to appeal to that audience, you should think of a use case that's going to appeal to that audience, not just necessarily the few trillion in crypto.
Yeah. Mike, thanks a lot. We are so grateful that you could allow us some of your time. You could spare some of your time for us. And I'm sure the audience that is hearing you, whether they are professionals working in the industry, whether they are builders right now who are trying to build something in crypto, or even whether they are some established companies or trying to work with Franklin, for example, I'm sure they will definitely learn a lot from this podcast today, as I have learned myself. So thanks a lot, Mike, again for taking a time for us. Thank you.